Okay, just see on the live stream. This is transform, move to top, Prashant, and then transform, move to top. Just see if you are able to see yourself on the live stream.
Yes, yes, super user is fine.
And can you see that feed? Are you visible and stuff?
Yes, 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 yes. Perfect.
Oh no, it's okay. Little bit bigger, and it would even bigger. Huh. Okay. It's done. WhatsApp is done. Leave page. And what I'll do is, I'll share so I'll share my Notion page. I don't know where you are putting the Google Meet because I'll show you what I can see. Okay.
Google Sheets.
You said you are putting the link.
Yeah, yeah, yeah. It's there in the same thing. I just pinned it on your WhatsApp chat as well.
Honey, that's fine. I just wanted to see where so that you can see what I can see. Okay. So let me share a window. I'll share my this thing. And one second, let me capture my display. Okay, I will here display one second minus. Let's do window capture. Okay, and then we'll capture my which is my Notion. This is my Notion.
Yes, yes,
Okay. Okay,
yes.
so can you see this?
Yes, Mr. Singh. Yeah, yeah.
Okay, and this is visible on Gmeet as well. No? Perfect. So
Yes.
so what I'm showing here is okay. So then you are not visible there. Okay. Then you have to see this thing. One second. Let me adjust this one so that you are able to see this on Gmeet now, but people are not able to see you because your face is getting covered. So
No,
I
that's
can't
okay.
share this.
I can see the screen on Zoom.
So I'll create one more screen. Just one second. I'll keep this as it is so that your face stays there, and I will add this this as the full screen. Okay. Is it possible for you to see this on YouTube? Is there a lag on YouTube?
The lag was always there.
Lag is always there. Acha,
Yeah,
theek hai.
very
One
little.
second. Then let me then manage something. Let me then change this layout so that you are also there and then capture you. So what I've done is I've pinned you, and I'll adjust the view. I'll put you in the sidebar and then capture this from the sidebar. And okay, done. And then what I'll do is I will remove you from the pin. Selected here, Prashant. Okay, and now I'll share this with my window. Here's my window. Share. You can now see this. And this is visible, now.
Yeah, yeah. Now it's good.
Okay. So, and then I have to unpin you, or I have to pin you actually, for myself only. Perfect. Now, oh yes, so that people on the stream can also see the same thing that I'm showing because they'll see it a bit in a smaller size. Like this. Folks on YouTube, just see the screen on the left, right? because I'm teaching from the screen on the right, so you will see one extra screen so that it's larger for you. And what else? This one. This one is I have to capture you. Alt down and here. Okay. Finally we are done. Thank you. Now you can see, people can also see, everyone can see. Very nice. I don't need a docs, I don't need scene, I don't need audio, I don't need screen transition. I need the controls, but I don't need the sources. I can make it extremely small, and I can bring it here. And right. Okay.
Yeah.
So you can see this one. Huh? This is my
Yeah.
okay. This is my, what do you say, Notion page. Here is where I'm putting like session details and tagging you. So where are you putting? So see, this is yesterday's thing note, and then there is this folder, and then there's session 2. Where did you put your Google Sheet? Because it's not refreshing here. It's surprising. So can you type something here just underneath the India market, because I've given you edit access, so it should work properly.
I see.
No, it says edited 19 hours ago. So I think whatever you are editing, it's not coming here.
Maybe am I not editing on a copy or something?
Prashant edited just now. Hi, this is a type check. Where is this going?
So this under session 1 itself, and just above the type check wala point is a embedded link.
No. Can you see my screen on Google Meet? I've opened the sidebar. It has the updates and analytics.
Yes.
It
Can
says,
you go to the type check? Yeah.
I clicked on this. Why is this not approving it? So because it has to come, because my other folks are also using this now. So I'm with other students as well. With that, it's working. I've given you full access. You're using the same thing, na? PSI to 2019. That's the one you're using, correct?
But can you also see the Google Docs embedded link on the top
No,
left?
no, no, no.
No. On the top left, just above the type check.
Full access. Can I edit comments here? On the
No,
top
here.
left.
Yeah. In a text section, there's a section called in class.
This one.
Yeah.
Now I can see this. So when did you put this? This was yesterday, I guess, na?
Yesterday.
Yesterday I got it. Yesterday I could see this one. So that's the only sheet, na? Acha, understood.
Yeah. I thought you will meet in the same sheet.
Very nice. Yeah. Then I can hear this. But where are you writing? This is a type check. Got it. It's working here. Come on. I've done like tons of live streaming. The boomer in me comes out someday or the other. Come on, Naval. Chalo. Good. So it's there. So it was all there. Because I was surprised that every time I'm doing this with like so many students for other courses, and this is why is this not working? Okay, so it's there. It's here. Okay, at Naval Singh. Yeah, at Prashant. Got it. This is a typing. Got it. So let me open the Google Sheets now. And for that, I will have to go here, come up, present something else, and then select Google Sheet. Is it the same tab? Or new tab? Just 1 second. Where is my Chrome tab. This one. Yes, present something else. This window. Share. This is one. This is the updated one, right?
Yes.
Perfect.
So there's a sheet called commentary and there's another sheet called days and seconds. So that is the two parts of the
So we went through all this, na? So the increase in receivables, is it because weaker demand often stretches channel credit? So we were right.
I mean, I understand GPT can hallucinate also, but what I did was I uploaded all the conference call transcripts and public disclosures as input. So as far as that's there, I think we are sorted. But again, this is a very difficult statement. You can't. The GPT is not able to pinpoint to one thing and say maybe this is exactly what could have led to it. I mean, again, despite all the input that we gave, it's still on the realm of plausibility.
It's usually the case because see, so trade receivable. So there are account payables and account receivable, right? APAR is the soul of business, and from there you have the for that our course moves to the next stage, which is today, where we talk about the working capital. Working capital is the heart and soul of business, and working capital only comes when you have current account, current assets and current liabilities. So if you have current assets more than current liabilities, you have some amount of working capital, right? So and that working capital is often given as advances. Suppose you are running a company, and an employee comes and says that there is an emergency in my family. Can I take 1 month salary advance? You cannot say that I don't have money, right? Suppose you have 100 employees. You're running a payroll of you are paying suppose them 1 lakh a month. You're running a payroll of 1 crore rupees, right? That's only for your salaries.
True.
And then you have a plant as well. Suppose an equipment goes bad, and the entire assembly line is stuck. So you will not go and do tender. What you will say, you will go to the nearest shopkeeper, nearest market, and then get a mechanic and ask him to repair it. Mechanic will say it will take around 2-3 lakh rupees. It's a machine of 50 crore rupees, but 2-3 lakh rupees can be mended. You will not say I'll not have 3 lakh. I don't have 3 lakh rupees, so I'll wait. I'll go and break my FD and get the money and then. So if you are running a plant with machinery, then you have to keep that much money in cash.
True.
In the same way, if you have 100 employees, you can assume that 1% or 2% will definitely come and ask for a salary advance, or because some exigency or some expenses. So these are sundry expenses which are kept in. So that's where. So the point is, suddenly an account receivable or account payable will not have such high variance unless if you are a manufacturing company. The most ideal, and if you have a just in time, so that's where again you go into the type of manufacturing. So you have MRP, you have GIT, and you have uh, we have these ways to predict what kind of market demand there is, and then you have VD and ABC kind of inventory planning, right? So if you are running a factory and you know that the market is not going to buy stuff, if you can quickly reduce your output and you can retool your assembly line to make something else, right? So, for example, Dettol during COVID suddenly needed a lot of sanitizers, but Dettol was not making so much sanitizers. So Dettol immediately was able to retool themselves to make sanitizers, to get the people into factories with PPE kits so that they can work, the factories can work, and then they would have to make so much sanitizer, and 3M had to make face masks and everything. So it's about, so that's an example of classic example of sudden peak demand. Right, and you have to suddenly retool your factory. So if you stop everything else. So for example, Dettol was making shampoo, soaps, shower gels, and everything. They would stop everything. They would just retool everything to make only sanitizers. Right?
Got it.
Yeah. In the same way, if the tires are not selling, if they can quickly retool to make something else, then the channel credit and receivables will not go up. Receivables are going up because they're not able to reduce their manufacturing.
Right.
and they are not able to reduce manufacturing because the raw material is keeping on coming. If they can tell that our products are not selling, so don't give me raw material, then their input will be lower, the assembly line will be idle, and they can put the people on furlough or some kind of a reduction in pay or reduction in working hour, or work 3 days a week or 2 days a week. Don't fire them, don't do retrenchments and everything. Those are possible. But that's the reason I'm saying it. If there is, as it's mentioned, channel credit in weaker demand environment often stretches. So this, which is B4, I'm reading line number 9. This is a classic example. So because that's how we can read a particular industry and how they are performing. Next is exports volatile. So what kind of their uh, products are going into emerging markets, and what kind of their products are going into developed markets. Developed markets will maybe provide them, vendors will give them some kind of um, credits, or they will do some kind of quality checks before generating an export credit certificate. And the moment that quality check is done, they may release the payment. The moment suppose the moment Apollo Tires sends the tires to Indonesia, the moment they land at the port, they are accepted, then the payment is released. But if they are coming to markets where those markets are also under stress, then this could be an international case of also vendor credit stretching a bit, right?
True. They're present in Europe as well.
Yeah, yeah. So the entire case, if the final distributor says that I'll only pay after I have received payment, then because the impact of market slowness is felt by the distributors and small shopkeepers the hardest, because they have very low working capital, so they just cannot afford to block their money in goods on their shop, because anyway they are giving you place in their shop to stock items, and now you're also asking them to pay money also, which is that's possible. Next is OEM weak, which is true, which is possible credit, extended credit to protect market share. So management admitted underperformance versus peers, which is what we had assumed, that if they do not do, they have like equal, I think, revenue scale. We had seen two equals. So this was Apollo and MRF are just equals, and MRF is king in Chennai. So MRF has factories in Chennai. So then, if Apollo fall, and Apollo I think is an international brand. So the moment they fall, MRF will take over their position in India. So they have to protect their market share. Actually, that's a good point that it's making here. So we can do some kind of mathematics here. Let me insert a column to the left, and let me just drag this. Come on, see, why am I not zooming this up? Where's the zoom? View, zoom, 125%. Oh, it's here. It's 150%. Okay. Command V, 81. Okay. And then let's copy these as well. Command C. Command V. See, their market share has fallen. 31 to 30. Insert one column to the left. And command C. Command V. See, 29, 30, 32. 31, 31, 30. So if we plot these three, I think we should plot only these two. But these two are equals. Insert chart. Yes. That's a classic parabola, no?
Yes.
So you have add x-axis. X-axis is this. Anyway, okay. So the market share of one is falling, the other is rising. Did the charts add x-axis? X-axis is this one. There is 3. Hey man, this Google Sheets is just amazing. Why do you do like this? No, it's not D. It's D2 to F2. Select the data range. This is the range, no? Yes. Okay. Let's go.
D2 to F2 is again the date value column, years value column.
So I'm just selecting this D, E, and F. Man, it's so difficult. Use row 4 as headers. No, row 4 is not. Use column G as head labels. No. Oh man, I should use. I guess Excel. Excel is much more intuitive. Why is not? Why is D2? If I only select D2, how does it select a date range? Select a range, okay, and I select this range. This, and this. One column required, okay. Oh, one column required. Oh, it has to be vertical. X-axis. Okay, take this column. How does that help you? Doesn't help. It's just garbage. Anyway, so the point here is this: that someone's market share fell and the other person's market share rose up. So as we had assumed that. Let's do a command set. Yeah, as we had assumed that this is the falling share is Apollo and this rising share is MRF. So one man's fall is the other man's gain. So MRF literally used this opportunity to grow bigger than Apollo. So that's the reason to protect this. But this will not uh, last them long if they do not have enough cash reserve. If these vendors, see, if you're a shopkeeper, doesn't matter. So what MRF can do right now, MRF anyway has larger market share. What MRF can do is start giving discounts and give run vendor promotions. So then vendors will start checking them. Vendors they anyway have extended vendor credit. Vendor will return this inventory back to them, and they will only sell this. It's like if I have Chorus and JK paper, I can sell Chorus paper. I don't need JK. I don't need built. I can say you can for me taking out a photocopy is photocopy. How do I care? I'll just use any paper. It's just the raw material for me, right? Unless a person comes. So now what? Understood. So now that is the game. The game is that they want people for to go and tell that I want Apollo tires. That's the reason they have sponsored Indian cricket team. Did you get it?
Yes, Mr. Singh. So
I come to you. So I come to you and I tell that I want this photocopy to be done on JK paper, and you will say, how does it matter? It's an A4 size paper, same GSM, 75 GSM. How does it matter? I said no. I want on JK paper only. Why will I say that? Nobody will ever come and tell that I want this photocopy to be done on JK paper only. Very rarely people say I want it to be 75 GSM paper, A4 size paper. That's it. Why will someone say that? Nobody will say that. How do I care? Why do I care? So I only care if I have the brand in my name. So they are, according to me, Apollo is fighting a losing battle. Very soon they will lose the India market share. MRF is going to win this battle. It's a very good account selected by you. They are living on a borrowed life. They are living. They will not survive longer. Unless we see something huge from the OEM side, that means they have large number of OEM contracts and those OEMs have sold a lot of cars and those cars have a lot of what do you say, strong performance indicators or something like that. Other than that, Apollo is dead. So
Wow.
we will see that on 14th of 15th of April, when they will be disclosing their numbers for the for the previous financial year. Because
Is
it's a,
there they can do any lever they can pull just to get back on track, just to mitigate all the dangerous things that you've got in themselves into?
huh, so this is a strategy masterclass, no? So if you are able to differentiate your product, and a
Uh,
final person is able to see that because my car has Apollo tires, or my scooter has Apollo tires, or my
mm,
truck has Apollo tires, I am able to get something better. I am able to get a better efficiency. My overall cost of operation comes down. My car needs lesser repairs. India's potholes are so bad that all the tires are getting worn out faster, better. This tire is better. Unless I can feel this, how do I care? I don't care. For
mm,
me, a tire is a tire is a tire.
true.
So long as both are equals so many diameter, both are radial tires or tubeless tires or alloy wheels and whatever, I don't care. So they have to now move to value based play, that they have to say that this is the long term value of using Apollo tires that only Apollo can give, MRF does not give. This is our research and development. We have made such a unique tire that when you use Apollo tires, so vehicle will run with very less maintenance. There will be lesser jerks. So if you are a provider of, say, industrial raw material, the material will not be damaged, and so on and so forth, and so many things. Other than that, there is no other way for them to protect the turf. Anyway, the turf is gone, as we just saw. And
Also, Mr. Yesterday you had asked me to check if there's an element, there's an entity called Apollo Finance. I forgot to do that. I'm just remembering.
do it,
So
na?
they have a
Let's do it.
finance
Let's do it
in,
live.
yeah, yeah. Would that help in any way? Having a financing wing, maybe obviously you're not differentiating a product, but
So,
keeping a
MRF,
financing wing
see,
will have to have
so
some benefits.
MRF can then tie up with Canara Bank and SBI and Punjab National Bank and some other bank, na?
Mm.
So they will not be bigger than this thing. So MRF can say, okay, you make your own bank. So Apollo can only win. So Apollo is based out of which country?
I think it is India, but they have a European presence as well.
No,
Maybe it became
Apollo's origin is from where? Just like Apple's origin is in Cupertino, California.
I
Apollo's
see.
origin is from where?
Netherlands.
Huh. So then what they will have to do is that they have to invest a lot of money from Netherlands in India through that
Mm.
Apollo Finance.
Mm-hmm.
And what they have to do is that they have to tell that India is growing, so that money will give better returns than investing in Europe. So they have to bring that money, invest in India through Apollo Tires.
Mm.
So they have to infuse more capital in the Apollo Tires Indian arm.
Mm.
So much so that MRF cannot ask SBI to invest. SBI, so these long-term forward trade contracts or long-term vendor financing or vendor advances or distributor advances are only done when the product is not selling.
Mm.
So can you go and see if MRF is also giving so much distributor advances?
Sure, sure, sure.
Just use
Mm.
LLM or MRF's this thing.
Yeah, yeah. I
And
think
if
I
it is
might have.
now, if it is, then put it on the this sheet only, because I have put the entire screen on share, so I can't see anything else other than the screen. So put this, either make a new tab or share on the this thing only. A screenshot of MRF's advances and this thing.
pasted it to the sheet at the very bottom.
Acha.
Yeah, and it looks like their trade receivables are
Which
increasing.
sheet? In the same revenue scale and growth sheet or some other sheet?
No, it's in the commentary sheet.
In the commentary sheet, acha. Okay. Scroll. Okay.
So their receivables are also increasing. It's gone from 2.8 up to I think 3.
Yeah, but not that big, na. It's only 500 crore. But yeah, they have also. But let's see what their um, investments and trade receivables. Can you also put their balance sheet? Can you also put their income statement?
Yeah, sure.
Just underneath this. And always in balance sheet, put the entire thing, not just asset. Both the equities and liabilities you have not put. Take the entire screenshot of the balance sheet when you put it. This is only asset part. A lot of story is there in the liability side.
Done.
Mm-hmm. Okay. I'm yet to see. Is it coming? No. It's vanished. Which cell have you pasted?
So the balance sheet, income statement is there on cell row 96.
Row 96. There is nothing there. It's completely blank.
Let me
Paste
refresh
has
my.
not worked. Let me also refresh my sheet. Refreshed. So there was one at 46 that has gone away and then it's completely blank.
In mine, I can see.
Now it is coming.
Perfect. Okay.
Yes, now got it. Okay. So we have financial liabilities. Okay. And lease liability, revenue from operation. Revenue from operation has grown. Cost of material consumed has grown. Changes in inventory. Okay, very good. Depreciation and amortization. There is no very large metal accounting policies. Same. Changes in inventory. That's so there is 418 crores worth of change in inventory, which is line number this thing, and they have taken a huge 200 crore depreciation charges and 300 crore other expenses. Can you see this one? 3865 to 4101. So area of interest is paragraph number 23. What are the other expenses? 300 crore other expenses, and then 420 crores change in inventory. So which is 20 and 23 paragraph. Purchases of stock in trade, no change. 20 and 23 has something interesting for us. Look at this column, MRF Limited. Look at the, so you're not showing the liability side, huh? The devil is in the liabilities. Look at the current liabilities. In current liabilities, look at number B. Total outstanding dues of creditors other than MSME. 1,000 crore, 1,067 crore extra outstanding.
My God.
Can you see this?
Yes, yes, yes.
So, and this is not in rupees and million, and there is no fancy business. This is pure crore rupees, right? If you scroll up, it's crores. Yeah, they are nicely done. Indian company. They'll not do. So this is Madras Rubber Foundation. I don't know what does MRF stand
Rubber
for.
factory, I think.
Madras Rubber Factory. It's proper Indian company. They'll do proper accounting. It's 1,000 crore extra. Why will there be suddenly 1,000 crore outstanding dues? And that is under trade payables. That's a current
Maybe.
liability. From where will you suddenly get some? This is the current liability. Something less than 1 year you have to pay. So how will you have? So is it? It is like if you have to buy a 1 crore house and a 1 lakh iPhone. For 1 lakh iPhone, you will take on credit card. For 1 crore, you will take a home loan, 15-year home loan. Right? You will not take 1 crore on credit card and 1 lakh on 15-year loan.
Yes.
So this is current liabilities. Where will they get in 1,070 crores in 1 year?
What is the logic here? I mean, is it? What do you think?
They are not paying money because they are not generating cash. See the long-term liability. See what is the non-current liability? Non-current liability is
More than one.
755 crores, which is long-term borrowings, which is like 5 years, more than 1 year, right? They have some provision, some deferred tax liability, not much change. Even the borrowings have increased. See the financial liabilities. The borrowings have increased from 6 to 55. They have taken 100 crore from somewhere. Look at number 11, just under the non-current liability, second line item.
Yes, yes, 100 crores increase.
They have taken it from some place. They have borrowed money. So their liabilities have increased like anything. That's the reason the total liabilities increased from 3,000 crore extra. From 26,000 crore, they have become 29,000 crore. So 3,000 crore extra they have taken. So they have. That's the reason they are now. What they would have done is they would have balanced that through creating an asset. So if you take long-term loan, then you are purchasing land, making factories. That's a long-term. That's a capital investment. So if you see here in the top, they have made 1,000 crore investment in property, plant, and equipment. Can you see the non-current assets?
Yes, Mr.
So if you take a loan to make a factory, everyone is happy, which is good long-term investment, which is 1,000 crore. But where is the remaining 2,000 crore going? The remaining 2,000 crore is going somewhere here. So they have made current assets investments, financial assets. See the current assets, the inventories have risen. The inventories have risen by 1,200 crores. Can you see this? 4,360 to 5,539.
Yes, Mr.
So why are they building so much inventory? 1,200 crores worth of extra inventory they have built. And they are also investing in plant and equipment. So if something is not selling, so you should not spend in plant, na?
Could it be like the cost of raw material is increasing, so I'm producing for the next couple of years in advance?
The raw material cost doesn't come there, na? Raw material cost will come in the P&L.
No, I'm saying since the raw material costs are increasing, what if I am producing for the next, let's say, 3 years worth of inventory, I'm producing in 1 year and I'm stocking it all?
Rubber will start deteriorating. Rubber starts, you cannot store rubber for long. It will become hard. It oxidizes. It will become hard and it will become brittle.
Okay.
So that's the reason. So you cannot. The moment you collect the sap from the rubber plant, then you put them, then you process it, then you have to quickly sell it. Natural rubber is a very rare commodity, and it's not like oil that you can keep it in a place and use it slowly. It will start deteriorating. Even your scooter tire, bike tire. Sorry, continue.
But this is finished goods inventory, right?
But then it's not stored in vacuum, na? It's stored in some godown or some kind of warehouse or somewhere. So the only reason I can see the investment in property, plant, and equipment is we are saying that if you mechanize the factory, then we can make tires cheaper. That is one. Or if we can, so that is the cost arbitrage that they are going, cost differentiation they are going, that we will become a cost leader. Just like the Indigo and Southwest Airline, they want to make cheaper tire. Second is MRF wants to make more expensive tires which can be sold in the cars in Europe, and then they want to compete in Europe. So then they want to invest in factory and make a nice factory so that they can make nice tires. Or they're inventing into IoT. They are investing into IoT, smart tire. The tires which have sensors, the sensors will send the data back to the truck. That data will come from tire to truck to mobile tower through a 2G or 3G data connection, and it will be fed to a server in MRF. That is what Bridgestone is doing. So what Bridgestone is doing, Bridgestone is saying that all our tires will act as sensors, and they will not sell tire. So if suppose your scooter tire is suppose rupees 2000 rupees, they will sell it to you at 200 rupees, and they will ask for a monthly subscription. So they will take on. Sorry.
That is dystopian.
No, that is actual truth. That's actually happening. And they will collect data of your tire usage, and they will collect, and they will not do it for a scooter. They are doing it for trucks, and I'm just giving an example. They are doing it for trucks. So if it is say 100 units of truck tire cost, they will charge only less, and they will use tire as a service. So they will take the tires back, replace your tires, the entire thing. So they will gather data of the tire utilization.
And so this will be extremely useful for fleet management, right? Because I can optimize, optimize terrain and everything.
Yes, and you can get a lot of data. You will have GPS data, you will have friction data, you will have accident data if you want to, collision data. If you will have lot of data will come from there. It's like having Google Maps on the tires, right? So everyone wants anyway wherever the person is going, tires are also going. Why not convert tires into own Google Maps? It's a free data for you. So there, even now modern day cars have TPMS, the tire pressure monitoring system, which can tell if the tire pressure is going down. So that's one part. Second is when the tire pressure goes down, the vehicle consumes more fuel. So if it's a petrol-driven car or petrol-driven bike, so same is true for your motorcycle as well. So your Suzuki Awareness mileage will fall if your tire is not properly inflated.
Yeah. And Mr. Singh, so in the live stream, right, I think your Notion window is hiding the number part of the balance sheet.
Okay. 1 second. Yeah. My Notion window is hiding.
No, Notion window is hiding the Excel sheet. It's all the way up front.
Okay. Because this was full. Okay, it was. The full screen should be coming, no? Okay. Now I think it would be this full screen only. So yeah, so here in the thanks for this part, because I thought I'm showing the full this thing only. I had put that on the full screen. It's not capturing the full screen maybe. OBS. So my thought here was second is it helps in the reducing the improving the mileage of the vehicle as well. Yes, no, maybe.
Yes.
Yeah. So that is then, as you mentioned, for fleet it's useful because they have hundreds and thousands of trucks which go for thousands of miles and thousands of hours. So it kind of helps them save money. It also helps to in the environment and ESG and make the vehicle go greener and everything. So from the efficiency perspective also, having data on tires and their state helps. So that's where they're going. So if that is something that they're doing, then the investment in the property, plant and equipment is understandable because the inventories are growing. If I come back here, now I look at the same profitability and the where is the annual report for Apollo? You had put the annual reports, the screenshot somewhere, right?
No, not of Apollo. But I'll do it. I'll just take a screen.
Okay, yeah, we were seeing it from that thing I had opened. Let me see if I still have it here somewhere. Apollo annual report. This one. Don't worry, I got it. No worries.
Oh.
This was page number 77 or something. 177.
192.
Yeah, 192. Okay, got it. So, oops, oops, oopsie. Yeah. Huh. So, what I'm saying here is trade receivables have gone up. So, they have gone up by 4,000. This is in millions. So 4,000 millions. It is 400 crores.
Hmm.
So in this case, Apollo is better than MRF because their receivables have only grown up by 400 crores. These folks, their receivables have grown up by 1,200 crores. See,
Yes.
receivables. The inventories have gone up, and they have not made a mention of in current asset. They have not mentioned trade receivables. Here in the current assets, they have made a mention. See, it has gone up by 500 crores. Same. So 500 crores here, 400 crores there, and then a jump in the inventory. 700 crore jump in inventory here. So everyone is building inventory and they have higher trade receivables. So which kind of shows that the market is cooling down. Let's see if both are equal, they have cash.
So sorry, but what does cooling down mean? Anything specific that you're referring to?
Yeah, cooling down means that the GDP growth rate is lower than the weighted average cost of capital, the WACC. If G is less than WACC, then the industry will not do more investments because investments will carry a negative rate of return.
Okay. Okay. Maybe I'll look into this part later.
In the discounted cash flow, you have a formula FCFF 1 plus G.
Yeah.
So there. Where's my tab? Let's see if I can. 1 second. Here. And okay. In my Google Chrome window, let me present something else. Let me present open board. Right. So, so enterprise value, right? So EV is FCF0 plus FCF1 plus FCF2, whatever. Free cash flow, right? So this is FCF0 plus FCF0 1 plus G, FCF0 1 plus G square. This is how it goes, right? So the entire formula finally becomes F0 1 plus G by R minus G till R terms, right? This is the enterprise value. Is my screen visible? I'm writing something. Is this visible to you? On Google Meet? Yes, no, maybe.
Sorry, I was mute. Yeah, so I can see both on Google Meet and live stream.
Acha, theek hai. So this is something. This is R 1 plus G, right? So this growth rate is the growth rate of company, right? So this is growth rate of Apollo, right? So this comes from RR into ROE. RR is retention ratio. So which is 1 minus dividend per share, dividend payout ratio, what is whatever this by DPS by EPS, this is into ROE. This is much as the company is able to generate. So suppose and this is the growth rate, and R is the WACC. This is weighted average cost of capital, right? So this is KD into cost of debt by debt plus equity plus KD into, it's not exactly this, into 1 minus T. Actually, 1 second. Because debt gives us some tax advantages. So it is cost of equity into equity by debt plus equity plus cost of debt into 1 minus T D plus E into D. Into D. This KD is cost of debt. So if you go to State Bank of India and get a 10% loan, and you take a debt of 1 crore rupees, and you suppose this is where the cost of equity comes into picture, right? So cost of equity is again comes from RF plus beta into RM minus RF and all those things, right? So this is risk-free rate plus beta plus market again this. So if risk-free rate is suppose fixed deposit you get 3%, right? And beta is suppose 1.1, right? And market is stock market is giving 10%. So 10 minus 3 is this. So this is 3 plus 1.1 into 7. 3 plus 7.7, it is 10.7. This is cost of equity. And suppose you have taken 1 crore is you have raised from equity, and 1 crore you have taken debt, right? And suppose the government of India gives an effective tax rate of 35%. Tax rate, right? So this formula will become cost of equity is what, 10.7, so it will become 0.107 into 1 by 2, 1 by 1 plus 1, this is 1 crore by 2 crore, and cost of debt you have taken 10% debt, so it is 0.1, 1 minus T, 1 minus 0.35, again you have taken 1 crore debt, so 1 by 2, right? So this becomes 0.107 plus 0.1 into 0.65, both by 2. This is what, 0.107 plus 0.065 by 2. This is what, 572,617.172 by 2. 0.086. This is 8.6%. 8.6% is your WACC. This is the hurdle rate. If your company is growing faster than 8.6%, then it makes sense for you to take 1 crore on debt at 10%. So how will you grow faster than this? That means R minus Z. So then this growth rate, so perpetual growth rate will always be less than WACC, but short-term growth rate, for that this will be the hurdle. This is what the money. So you have to at least grow at 8.60001 for you to make money, right? That is the economic value add.
Okay.
Which is a return on capital minus cost of capital. Then you have invested capital into ROC into, plus you have some other stuff, but the core funda is that you still have to have return more than cost of it. So this is the way. So the market is cooling off if the returns are lower than the cost of capital. So the moment this cost of capital you are not able to get that much cost of capital return, the company will not be able to generate free cash flow. So then what they will do, they will stop taking loans. The moment they stop taking, so I'll show the red. So the moment this thing falls, it will go and hit this one. So you will not take loans. This 1 crore will fall, because you know that if you take loan, if you lose your job, God forbid, then you will not take loan from bank because you don't know whether you can pay the EMI. Then you will not take loan. The moment you will not take loan, the bank will have lots of money. The bank will be forced to put money on market. So then these interest rates will fall. Bank will try to attract you by reducing this. They will try to make 10% will become 9.5%. It will become 9%. RBI will cut repo rate, and all those things will happen. Then the macroeconomic things will happen. If this is the microeconomic, this is only for one person, then the macro scenario will change from there only. You got the idea, right? So this is what the cooling off from the macro trends looks like.
Okay.
And that's how you understand whether it's profitable for you to run your company or not. So suppose, let's consider another scenario. Suppose, right? Let's suppose that Apollo, how much debt they have. 1 second. Current debt is current liability, current short-term debt, long-term debt, current portion of long-term debt. So long term, this is the short term, that is current liability, borrowings around this much, 10,000, and 18 to 28. Current portion of long term debt will not be that much. It will be, assume it's like 5-6 years, maturing in 5-6 years. So this will be like, current portion of long term debt will be by 5, 3 plus 10, 13 around. Or let's assume that they have taken everything on this thing, on debt, and this is the current portion. And then what is the equity that they have raised? So the equity they have raised is 106, right? 106, and this is the non-current liability. This is the total equity and liability. So how,
I think your screen is stuck in the whiteboard, Mr. Sir.
Okay. Then let me take a screenshot and put it up there. 1 second.
Or maybe I'll refer to the.
No problem. I'll just give me a sec. I'll take the screenshot of this and I'll add that to current page. So is now this thing visible? Is the on whiteboard? You can see the whiteboard, right?
Yes.
On whiteboard you can see the screenshot.
Yeah.
So this is for, I think this is for Apollo, I guess. So Apollo has this much. So Apollo now has total equity and liabilities 200, whatever, 200 units, let's say. 203 units. Out of this 203, we have how much debt and how much equity. So you have equity is 106, right? Can you see this? The one that I've made an arrow. Yeah. And then remaining is debt. Right? So okay. So equity is 106 and debt is remaining. So assume whatever, it's 97. Some form or the other form of debt, or it's not actually debt, but just for the sake of mathematics, let's take this as debt. And what is the debt by debt plus equity? 97 by 203. It's around 0.5 only. 100 by 200, approximately 0.5. 50%. So they have taken half debt, half equity. That's exactly what we have done in the previous sheet, right? We have taken one half here. You see, this one is half. If it's this one, 0.5 and 0.5. Half debt, half equity. So with that, and then so this cost of capital works for us, 8.6. Assuming that they will not have taken 10%, they will have taken at 4 or 5%. But whatever with this 10%, you will substitute it here. This is the cost of debt. Then you would have some tax benefits coming in here due to benefits on the repayment of the debt. So this will have marginal tax rate coming in as 1 minus 0.35, and then you will have 1. This is the net cost of debt becomes 0.6. So that's the reason a lot of companies take a lot of debt, because of tax benefit. This marginal tax rate comes down. So this reduces the cost of capital for them. In this case, this long answer to your question, 8.6 is the expected return on their investment. Right? So if I quit this and I come back here, I hope on my Gmeet I am Let me go back and start sharing my this screen. Huh. So this is, so if we come back here, then you can see that the same examples of both current portion of long-term debt. So and both long-term debt, they are impacting their working capital here. The capital work in progress, you see here, capex, plant modernization, capacity expansion with increased cost, capitalization pipeline not planned. So see higher tech and digital spend. This is where they are doing the smart tires and stuff. So those are investments made in the final product. So the tire will have its own SIM card or whatever. It has its own set of sensors built in. You would have purchased sensors. You would have set up the assembly line to attach those sensors to a tire and whatever, right? And then see this term deposits have dropped sharply. So from that means that so they are the cash is they're using the cash to do debt repayments. So the working capital will fall, and they are using the working cash and cash equivalent for capex funding, right? So that means that they have used the cash to redeploy it somewhere else or give loans to the other parties, and other fall here as well. Did you see why did they? Did you see that they have a finance arm? Why they did this mutual fund thing?
No.
Can you ask? Can you ask that large language model where you have fed this? That does it make sense to for a tire company to invest in mutual funds? So, for example, if you are a employee, then if you invest in your education, skill building, it makes sense. If you invest in betting and poker, then it not adding in your core competence is to be a management graduate. So you spend money, you do an MBA, you spend money, skill yourself, learn digital marketing, programming, whatever is relevant for certification, then that makes sense. Why will a tire company invest in mutual funds?
So GPT is saying that usually tire businesses are so and so, and since they have very volatile working capital cycles, it makes sense for them to park their money in mutual funds at least for a very short while, just so they can earn 5 to 7% instead of sub 5.
But okay, but the capital erosion risk is there, na?
Yes.
Mutual funds are not fixed deposits.
Yes.
So what if the mutual fund ask this? What if that would have isn't does it create financial risk and a business risk and is a red flag?
GPT is still saying that it depends entirely on the kind of mutual funds. I mean, obviously there is a risk, more market erosion.
But of course, there are some mutual funds will protect the capital, but the capital is also protected in the benefit of using fixed deposits and others that you can take debt and so many things. Anyway, let's look at the leasing part. I want to see if the leasing is mentioned today because if you see here on my new tab here, so there they have leases, right? So there they have capital leases, current leases, and whatever.
Yes, this part is ours today.
Yeah. So these leases helps in reducing the upfront investment of money in whatever property or assets that they are taking into their own books, right? So a company does not have any lease commitments or variable rent as per the contract. So rent, which is good, everything is fixed. There is no variable. Lease agreements for warehouses, plant and equipment, and offices. both for lessee. Each lease imposes restrictions. These are all, I think, operating lease. They're not capital lease. Assets to another party that to use can be non-cancelable or cancelled by incurring substantial termination fees. Okay. This prohibiting selling the leases or office building, communicating a good state of repair and return the property to original condition. Okay, understood. So not much change here in current and non-current leases here. So what we can suggest or we can infer here, change in carrying value of right of use assets by have the assets depreciated a lot. So additions have increased here. And the impact on the working capital. So if they can save money by leasing, that's where you will be really interested. So this is land and building, plant and equipment. So land and building, this is use of asset, land and building 2023, 2024, addition, disposal, slight here, accumulated depreciation is here. You can actually claim tax benefit on the lease payment and the depreciation here as well. So the net carrying value here is this much. This is a depreciation expense that they have claimed. It's a non-cash expense here. So they have depreciated from here. Plant and equipment here, non-cash expense. So they have claimed on line 42 as the depreciation expense. They've disposed some assets. This is again comes as, you remember you asked how it's called as cash. They would have sold and got cash. This depreciation is something that they have claimed because they will have to keep on paying this, so that this would be dependent on the term of those lease for which they have claimed depreciation. So assuming this is 8,000, accumulated depreciation 3,000, it means it is taken 3 years ago. If it's an 8-year lease, and every year they are deducting 150, so and they're adding it to accumulated depreciation. So if they add, if you depreciation expense and disposal, they will add this here. This minus this, they will add it here. This minus this, they will add it here, right? And then the net carrying value is so and so, and then so and so. So they will. So they would have some kind of manufacturing utility or growth of the equipment or replacement of the equipment, because the plant and equipment are very cheap. I don't think the rubber industry or the tire industry needs a lot of expensive equipment. The main cost is only land and building. This is just 40 crore rupees of equipment. 39.4 million is 40 crore rupees. They have spent a lot of money in land and building. That means for this is the accumulated depreciation. But what is the actual value of these assets, plant and equipment? Let's go. It's 192, right? 192. Property, plant and equipment 1 lakh. Whatever, 10,000 crore.
Okay.
Intangible asset, right of use, ROU assets, right of use assets. This is something that they would have taken under lease. And what else? Other assets. Okay, these are all financial assets. Inventories. Okay, the current assets. These are all. It comes somewhere around here as well. So only in property, plant and equipment, if the breakup of this 10,000 crore, and I do 2 to 5, of this 2 to 5 here is this land, and this is 10,000, whatever, 923 crores, a gross carrying value of land and building. So literally 80% of their assets is land and building. Property is nothing. Property is negligible here. Gross carrying value here again, it's following the amount recognized, depreciation right of use, liability. Usually equipment is something that most of the capital companies will like to give it on lease, on a or higher purchase agreement. Land is something that usually is directly taken from land party, and land parcels are taken by industrial technology park, and from those technology park you take that land on long-term lease, and then you set up a factory and you run it. And if you close the factory, you return that land. Suppose there is an SEZ or there is some kind of a technology park, and then so that's how you don't purchase the land on lease. You get it um, from a park usually. Yeah. And anyway, the value is very small here. The value of land is very high. The plant and equipment is very small. So if we come back to the what we have done here. So if we have to do um, um, an impact on 5 crore machinery funding, so then they will not have to depend only on current working capital, or um, they can get it from leasing. This is the impact that we need to calculate. 5 crore machinery funding and the working capital impact while leasing. So, should you get that machinery on lease or versus procuring it? So, for this, if we come back here, what is there? Let's go to page 192. This is for Apollo tires, 5 crore. Current assets, current liabilities. Total current assets 6,000 crore, 6365, and total current liabilities 5605. So they have 400 crore worth of current working capital. That means 5 crore worth of machinery is rounding error for them. It's a very small value. Let's make it 50 crore worth of machinery. So then it will make an impact. It will block around 10% of their working capital. So that is something that you make a calculation.
Okay.
So that they have to buy, instead of 5 crore, I'm just changing the assignment to 50 crore. That they have to suddenly invest 50 crore in a machinery. And what is the impact on working capital if they take it through lease? Asset through lease. How would you calculate? How would you first calculate the current working capital, and then look at all the expenses that they are doing, daily expenses, and assume that they should have at least um, find the days sales, find the total days sales outstanding and days receivable outstanding. How do you find that? You divide the total
Like COGS into 365.
Divide total revenue and then by this. So if the total revenue is suppose 1200 rupees, that means they sell 100 rupees worth of stuff, and they have suppose 300 rupees worth of stuff receivable. So they have 90 days of it takes for them to sell the items and get the payment, right? So their current working capital stretches by so many days. That's how they have get the inventory. So inventory days would be very high for them. They are anyway having huge inventory. Yes. Receivable day will again be stressed because they're not getting payment here. They are also delaying payment to their own creditors, so that the payable days will be high. So do a calculation on the cash conversion cycle, and then with that stretched payment, and they're also using their current capital to repay their long-term loans. So with that, if you want to do it yourself, do it, or put it on LLM. That's also fine. Make a table of impact via leasing with for 50 crore machinery funding versus direct payment upfront, and claiming depreciation. So what you can do is you can spend 50 crore rupees and convert that into capital asset, and then claim depreciation over the lifetime of that machinery. So suppose that machinery is what, 25 years or 20 years or 10 years. You can claim 5 crore rupees depreciation under straight line depreciation method. That is one way. Second is not pay 50 crore rupees upfront. Just take the entire machinery on lease, and then also get a tax benefit on the lease amount that you are paying.
Correct.
Right? But those lease terms have to be finalized upfront versus this thing. So does the company need upfront capital and those kind of things? Okay? Is this something that you would be able to do and come back?
Yes. I have 1 week's time. No, I
Yes.
think that would be necessary.
Okay, so let me come here and stop sharing.
Hmm.
And let me